My name is Andrew Stotts, and I want to welcome you to this session of the final presentation of one of our Valuation Master Class graduates. This is a presentation of a student who started in the Valuation Master Class Bootcamp and then went on to professional. This is the ultimate of where our students get to, and usually they're starting from scratch. So let me invite him in and get started. But remember, if you want to build a competitive advantage in company valuation, just go to valuationmasterclass.com and learn about the next bootcamp, which we start on the 26th of May. So without further ado, all right, Nordara, how are you?
Hello, sir. Hello, everyone. How's
Yeah,
it going?
I think we're all excited. And
Yep.
particularly nowadays, everybody wants to know what the heck's going to happen with Tesla.
Yes.
So I think it's a good time to spend some time on Tesla. And I know you've worked your butt off to get to this point. So what I'm going to do first of all is I'm going to bring up your presentation, and let's see. Okay, and I got your presentation showing, and your face is also showing. So I am going to leave this in just a second. When I do, you should start. Are you ready to go?
Yes, sir. Ready?
Okay, I'm in leaving right now, so you can start now.
What if I told you the world's most talked about car company isn't just racing on the road, but on a financial tightrope between hype and hard numbers? I, Dara, will walk you through Tesla valuation, the slim success for EV leadership. I initiate coverage on Tesla with a sell recommendation based on a target price of 107 US dollar, implying a downside of 48%. I derive my target price from a free cash flow based valuation using a WACC of 9.8% and a terminal growth rate of 5%. Tesla sparked the EV revolution. But now the race is started, is closing in fast, and the road ahead is anything but smooth. Despite rolling out aggressive price cuts across major markets like the US, Europe, and China, Tesla hasn't seen the demand rebound it was hoping for. In Hong Kong, for example, prices were slashed by nearly double digits. At the same time, legacy automakers such as BMW are gaining ground in the EV space. The consequences? Declining sales and shrinking profit margins are starting to erode the revenue. Once seen as a future growth engine is now facing mounting regulatory and safety concerns. In China, Tesla vehicles are banned from military areas due to national security concerns, while the EU continues to withhold approval for the safety issues. So regulatory delays are undermining what Tesla hoped would become a major revenue stream. Lastly, the Tesla's global production engine is showing signs of stress. In Germany, the Berlin Gigafactory was recently forced to shut down after a massive arson attack. In Shanghai, production has paused amid weakening demand and supply chain bottlenecks. All of this lead to one conclusion. Factory shutdowns and labor issues are driving up the cost and disrupting production. Now, moving to constrained growth. While others see roadblocks, Tesla sees speed bumps and is accelerating anyway. Currently, we study four constraints. Firstly, capital constraint is neutral. Tesla aggressive growth plans, including new gigafactories in India, Indonesia, and Turkey, plus heavy investment in AI and full self-driving are capital intensive. So while the long term is bold, the short term pressure is a real risk. For operation, it is minor constraint. Tesla faces several bumps. Factory shutdowns in Germany, production slowdown in China, and cut to the casting expansion are all signs of strain. While these aren't yet critical, they're beginning to impact Tesla's ability to scale smoothly. Thirdly, market constraint is minor. Tesla still leads in EV, but its market share is being chipped away. European competitors like Volkswagen and BMW are catching up, while Chinese brands compete aggressively on the price. Emerging markets like India and Indonesia offer growth potential, but come with regulatory and logistical hurdles. So the competitive landscape is tightening. Finally, people-related risk are Tesla's most significant threat right now, showing major constraint. Their growing unrest at the German factory over wages and working conditions, leading to union pressure and forced pay hikes. Altogether, these human capital issues could directly impact productivity and the long-term growth. Tesla may be American made, but its future is being written in Shanghai, Berlin, and beyond. In 2024, Tesla revenue grew by a modest 1%. That is $917 million more than 2023. The standout being big gains outside core car sales. Energy storage up to 40%, the regulatory credits up to 35%, and services up to 21%. Meanwhile, automotive sales dropped 8% due to price cut and fewer deliveries. Regionally, the US led with $2 billion growth, but China slipped by $801 million amid the economic challenges. Looking ahead, I forecast a 5% ahead jump in 2025 thanks to the market expansion. Tesla future, more than just a car, is about energy, software, and global going as well. Here we study FEMR framework on Tesla. Let's start with the big picture. Tesla ranks neutral compared to 1,800 non-financial US companies. That means when we look at its fundamentals, valuation, momentum, and risk, the positive and negative balance it out. It's not leading, but it's not falling behind either. Tesla um, Tesla fundamentals are solid. It remains profitable and rank above the average in this category. However, there's pressure. Margins are declining, driven by price cuts in competitive markets like China and Europe, along with rising production costs. The company is still financially healthy, but the cracks they're showing. On valuation, Tesla ranks near bottom. Its high market cap is propped up by the hype around AI and full self-driving, not by strong earning. Tesla momentum is slightly above average, but there are signs of slowdown. Revenue growth is decelerating, and production cuts in Germany and China, this reflect the weakening EV demands. On the risk front, Tesla scores below average. Recent factory shutdown and widespread layoff and the issue on politics like Red Sea conflicts are tighter. Chinese regulations are increasing the uncertainty. When you control the supply chain and set the pace, new entrants aren't competition. They're just trying to catch up. We study Porter 5 Force with rank of 100% is the most attractive from Tesla. Rivalry among competitors ranked 53%. Tesla operates in a highly competitive space. It's up against legacy giants like Volkswagen and Ford, BMW, all of that cars. And at the same time, EV space is being disrupted by new tech from better batteries and autonomous driving. Bargaining power with supply ranks 73%. Tesla does rely on major suppliers like Panasonic, LG, and Samsung, especially for batteries and chips. During the chip storage shortage, supplier power wasn't clearly felt across the industry. More importantly, Tesla is actively pushing back on supplier power through vertical integration. Bargaining power with customer ranked 53%. Tesla customers are gaining more power as EV market gets crowded. With brand like BYD, Volkswagen, Rivian and Lucid offering competitive alternatives, buyers have more choices than ever. Entering the EV industry is no joke. Threat of new entrants ranked 67%. It required massive investment in R&D, manufacturing, and supply chains. While Tesla benefits from a first mover advantage, government incentives are making it easy for new players to enter. However, securing crucial raw materials like lithium cobalt is tough also. Threat of substitute rank 60%. Switching from Tesla to another EV is relatively easy for customers. However, Tesla has built lock-in effect with its product, making it harder for customers to actually switch without losing their benefits. In terms of product differentiation, Tesla stand out the most with its autonomous driving, battery performance, and tech-first approach as well. Now, moving to leadership and the share in the market as well. We know that um, for chairman, it is Robin Denholm and Elon Musk as the chairman as well, CEO. For the market, Tesla, we see that there's um, two two independent director and six non-independent director. And for the average in the industry, there are two independent and eight non-independent directors. Now, don't get overwhelmed by this triangle. It's called world-class benchmarking. It's our tool to break down Tesla performance and asset utilization. And trust me, it's simpler than it looks. In 2020, Tesla profitable growth was ranked in the sixth decile, but surprisingly, it surged ahead of 870 consumer discretionary companies globally. By 2022 and 2023, Tesla profitability reached the first decile, staying strong over the past 12 months. In terms of growth, Tesla showed positive result from 2020 to 2021. But by 2023, growth slowed, dragging it to the fifth decile. Despite this, Tesla revenue performance was strong from 2020 to 2023, outpacing many competitors. Profitability. Tesla reached the first decile in 2020 for the first time. It clears sign of its strong financial strength. Growth slowed, dropping to the fifth decile in 2023 and further to the sixth decile in the past 12 months. Asset utilization. Tesla ranked in the sixth decile, but is showing improvement, especially compared to global peers. Net margin, on the other hand, one of the Tesla's strongest area, it mentioned first decile dominant in both 2022 and 2023. Cell growth, cell performance weakened in 2023, falling to the second decile. Net margin change, profit margins are still high, but growth slowed, landing in the seventh decile. Welcome. This is the ESG framework. They're similar to Porter 4's 100% mean that Tesla is attractive. Firstly, environment ranks 60%. Tesla promotes sustainability with a resource reduction policy and efforts to cut waste across operation. However, it has faced environmental controversy, particularly regarding its cobalt supply chain and manufacturing impact. Its core products are designed to support the environment. For social, it's a perfect score. Tesla still has health and safety policy in place, but there have been concerns about their effectiveness. The company also has human rights policies, particularly around in supply chain. Through this, they have criticism for lack of comprehensiveness and enforcement. Finally, governance ranked the lowest of 40%. Tesla board independence has been criticized, especially due to ties with CEO Elon Musk's other ventures. While, while Elon Musk is CEO, he stepped down as chairman in 2018 following a settlement with the SEC. Now let's move to the profit and loss statement. For revenue here, I forecast it to be slowing down in the fade period because of the competitor are actually gaining their upper hand. The cost of goods are actually also it will increase along the way, but you can see here that advertisement, it will help the revenue to go up as well. For our balance sheet, the asset, if we look at the cash and short-term investment, I keep it increase. This does not mean it's because of the holding for account receivable inventory, but because of the payable. I believe that more time, the supplier, they will shift to other competitor, so the payable day will actually go lower, greater. For liabilities and equities, you can see here that overdraft, I forecast it to be lower. Payable, it will go increase, but not such a great rate. The long-term debt, I forecast it to be lower. For cash flow statement, we can see that the capex here is actually gaining because of the industry factory. They're starting to expand around the area, and the debt is decreasing. Next, we move to our ratio. The current ratio and quick ratio look great. The cash conversion cycle, I forecast it to actually increase than the past year. This is because of the supplier made they actually changing to other competitors of Tesla. For the free cash flow data here, we can see the free cash flow to firm and free cash flow to our equity. Same thing, we can see the changes in working capital. I forecast it to increase along the way. And for CAPEX, also increase due to the expansion as well. Moving to relative valuation. In 2025, Tesla has the highest BP to RE ratio globally, driven by its high BP ratio. Despite a decline in RE from 34% in 2020 to 20% in 2025, Tesla valuation remains high due to investor confidence in long-term growth from expansion. And Tesla capital-intensive strategy like price cut and competition have pressured profitability. In contrast, Tesla has the lowest PE to growth ratio compared to Asia, excluding Japan, world, and USA, driven by the company highest EPS growth in 2025. Okay. However, risk like factory shutdowns and price cut in the market may pressure margins. Despite this challenge, its long-term growth prospect keep its PE to growth ratio favorable compared to other markets. For valuation model, I assume a free risk rate of 2.2% and a market premium for the US market of 7%, like the recent past. Tesla have been high beta stock, thus I assume a beta of 1.3. I forecast a capital structure with 15% debt to total capital. In the current level, this result in a WACC of 9.8%, and I use a terminal growth rate of 5% with free cash flow to firm model. Now, if I were to do sensitivity analysis, my base case assumes 15% sales growth, resulting in a value of $107 US dollar per share, a 48% downside compared to the current market price. My optimistic case assumes 16% sales growth, resulting value of $109 or 2% higher than my base case. In my pessimistic case, I look at if Tesla sale will grow by 13% only, and the value would be $105 or 2% lower than my base case. Lastly, for the risk, I search 5 risks. Firstly, global sale and delivery challenges. Tesla might struggles with expanding its global sales and delivery network. Second, battery and supply and cost control. Tesla may depend on few suppliers for battery, and if it is to disrupt, it can affect the vehicle as well. Thirdly, production and manufacturing risk. Tesla might face delays and supply chain issues. Fourth, gigafactory and battery tech risk. The factory disruption or safety risks related to the batteries could impact the production. And lastly, demand forecasting and market uncertainty. Misjudging demand for different models or products could lead to the inefficiency as well. That's all. Thank you.
Excellent, excellent. Oh, I have so many questions about Tesla. On the one hand, I was thinking about should it have cut its prices so much? But then when I looked at the world-class benchmarking scorecard, I thought, I'm not so worried about their net margin as an example. But then I see net margin kind of collapsing recently, and then I start to worry about it. So can you give your perspective on, what's happening with the margin of this business over the next few years? Maybe you could even go to your ratio page and let's just look at your margin assumptions for gross, and EBIT margin in particular.
Right. Yes. Okay. Um, right. So I would say that for the next year in the future, Tesla would try to stay competitive in the market. However, it I would say look into the cost structure of Tesla as well with the supplier. They might not be easy with Tesla because of the competition. We can see that there's many EV production in China that's have been going around, and it can disrupt the supply chain to the US as well. Um, and if we add into the US tariff, this disruption could make like high cost to the Tesla company as well. Yeah.
Okay. And if I look at your margin assumptions,
Yep.
you're relatively positive, right? You see gross margin rising, you see EBIT rising, even though it's been, weak recently. So even with this positive assumption, you still end up with a lot of downside.
Yes. Yes.
Um, One of the things that's interesting about Tesla is that there's very few car companies that have a negative cash conversion cycle. So can we look at your free cash flow forecast to try to understand how that impacts free cash flow, the fact that, it's negative or small? Let's talk about the changes in working capital and how does that look?
Right. For the changes in working capital, I base it mainly. I focus mainly into the payable, and you can see that the payable it will start to increase, but like in a I would say not a big rate. And for the receivable, we can see that it start to increase, but like in the fade period, it is like not that much increase in a short rate, I would say. Yeah.
Okay. So what we can see is that uh, the impact of changes in net working capital is very small for Tesla, probably compared to other traditional ones. Now let's talk about capex. So I see in 2021 it was 7,742, then 6.2 billion, and then 8.9 billion. Now you've got that almost doubling to 15 billion by 2028, but you also have revenue almost doubling by that time. But how do you feel about what's the risk to your capex assumption? Do you think you're conservative and they are going to spend less, or you think it's likely they'll spend more?
Right. I would say that they're gonna spend more. I'm being a bit aggressive here. I would say they would try to build their factories. I would say much faster in the next year, maybe 2025 or 2026, because of the I would say the market share for maybe China companies starting to grow, so they can fight them off.
It's interesting also that even with, you know, it's amazing how the free cash flow of the firm is going to get up to 20 billion by 2028, even with a large amount of capex. Now that's coming from also from the increase in EBIT, but and yet you still get some downside. So let's go look at the next couple of slides down to look at your assumptions on discount rate and the like.
Right.
Yeah, keep going down. Yeah, keep going down. This one. Okay. So if I look at your discount rate for your cost of equity, I would say, I wouldn't say it's high, but I would say that, you know, it could be down a little bit. That would give you a little bit less of a downside, but probably not by a huge amount. And your weighted average cost of capital, you're using about 15% debt as a percent of total capital, which it's not a highly capitalized company, not a lot of debt. So, geez, even with the positive free cash flow and with a relatively reasonable discount rate, you still have some, this challenge of not having much upside at all. Let's look at a question we got from one of our bootcamp graduates, Roman Letter, who says, do you see Tesla's competitive advantage being diminished due to innovative developments from BYD, like faster charging batteries? And is BYD's foothold gaining traction in Germany?
Right. Yes, thank you for the question. For the BYD company, they actually got a good innovation if we compare it to Tesla. But here's what I personally think. If you look into the financial structure and how Tesla operates, Tesla would if compared to BYD, Tesla actually getting the upper hand, meaning that they can make I would say the car, all of their production would be more cost effective than BYD. However, in the long run, I would say BYD would have the upper hand to innovation, like innovation, technology, and all of that stuff. And back to your question, for the stock, I would say Tesla gonna get a bit hit with the audience, with how investor perceive it, but not that much, just a bit like hit if we compare to BYD.
It's kind of incredible because nobody would have expected a company would be a high-tech company in the automotive space, and then Tesla appears, and then before you know it, they're facing another very, very strong tech competitor. It's
Yeah.
amazing how the landscape has changed, and I'm talking about BYD. So it's very, very interesting. So how does it feel to graduate from the Valuation Master Class?
I feel great. I feel amazing to graduate from the master class, but yeah, I also miss many memories and all the lesson that as a professor had taught me. But overall, yeah, it feel really great.
And how would you describe your transformation? Like, what's different about you today versus when you started?
Okay, so for my transformation, back when I was bootcamp student, I don't really know valuation. I don't know it that much, right? And I
Mm.
struggle to find the value of the share. I struggle to do the forecast, finding news, looking at how each company is going to affect one another is a hassle. But if you compare to now, I would say I have more confidence in doing company valuation. I start to look more depth into how each company affected by the stock price, affected by the supply chain, other competitive advantage, and all of that. It helped me in doing better job at valuation and staying a better version of myself in doing company research as well. Yep.
And how would you describe the difference between your skill level from the end of the boot camp, when you graduate from boot camp, till you finish professional?
Right. For my skill, back when I was boot camp, I struggled with doing forecasts, with writing all of that stuff, struggling with finding the right, I would say, punchy headline, when doing the story, making concluding sentence. And looking at valuation, I was basically like trying to understand what each um, technical word into the valuation is. But compared to now, it got much better. I actually understand like what is cost of debt, what is cost of equity, and how to do the valuation, how to write the story. This is as well.
Yeah, it's becoming more intuitive.
Right.
That's great. Fantastic. Well, I just want to congratulate you. I know it's a lot of time. We talked about the number of hours. How many hours would you say you've spent between boot camp and professional?
I would say 100 plus, 150 plus to 200 hours. A
Mm,
lot. Yep.
yeah, a lot of work. Well
Yes.
done. And let's I'll be in touch through Slack, and still be a part of that community, and maybe you can mentor some of the upcoming students in our next boot camp and give them some guidance, because they're going to be struggling like you were in the beginning.
Yes, sir.
All
Definitely.
right.
Yes.
Well done. I'm going to take you out of this, and then I'll talk to you later.
Right. Thanks so much.
Congratulations. Yep.
Yes.
Yep. Well, that was a great presentation and a great update on Tesla. I really find it challenging because, you know, cutting the price of the cars and then seeing the margin go down, but yet still the margin is pretty strong. And, they've got so many different things going on that it's hard to turn negative on it. But as you saw, that was a lot of downside, 45% or so. Also, what's fascinating is just the intense pressure that BYD is putting on the whole industry, and they're innovating at an incredible pace. And so that is going to be fascinating. And then, of course, you add in all the geopolitical risks for Tesla, and it's really, really scary. So there's a lot of risks out there. If you want to build a competitive advantage in company valuation, like you just saw Dara do, well, come visit valuationmasterclass.com